500 went up 14.3% on average for 18 years. The average U.S. equity mutual fund went up 13.1% per year. So would everybody like to have that return? Would that be get you to your destination, accomplish your goals? It's a map, you could follow that. Would we be okay with that, Todd? Yeah. Be a fair bit of money? Take $10,000, turn it into 100 grand? Unfortunately, what happened, because people don't stop at Oasis and they don't pay attention and they don't have a compass, is they end up, the average investor actually only got 2.6%. So his $10,000 became worth $15,000. Now, as you can appreciate, this is sort of like dying in the desert, isn't it? Because when you get there, you don't have enough strength, you don't have the capital to live out the rest of your life. You're finished. So when I was thinking about Steve's talk and Steve's book, I said, how do you relate this to financial planning? How do you get this down to people? And of course, one of the laws that Steve talked about was a compass. Now, often we talk to planners, or if you go down and see your local bank planner, what you end up with is you're supposed to get this written plan. People often say to me, Cy, you know, do you do written plans? Well, I don't do written plans. I have no intention of doing written plans. I have software that can do written plans, but I don't do written plans because written plans are like your map. They won't get you to where you want to go because all of the things that are in the plan are not going to happen the way they are in the plan, just like the dunes are going to move and the mountains are going to be in the right spot and you're going to end up getting lost. So what I thought about is what's our compass? So there are two powerful images that Steve used in his presentation that I'd like to equate to our world. And the gentleman that we've been using as a nomad, although I'm not sure you should call him a nomad, is a gentleman named Warren Buffett. And this nomad happens to be the second wealthiest person in the world. Now, interestingly enough, he became the second wealthiest person in the world without ever personally managing a company. We all know that the people with the money own businesses. Is that not very, very common? I mean, all of the people that we know that have a lot of money had their own business. And yet here's a guy who became the second wealthiest person in the world without doing that. He was an investor. So, by a show of hands, is there a possibility that he would be a good nomad? Would he be, you know, if you needed to know how to get to financial independence, financial success, would Warren Buffett not be a good person? Come on, everybody, would we? I mean, really? So, what Warren Buffett said is success as an investor does not require a high IQ, an unusual business insight, or insider information. So we don't need that. Guess what? How many of us have that? How many of us have a extremely high IQ? Actually, I do. Have an extremely high IQ, outstanding business insight, or insider information. So if we don't need that, he may have a good plan for us, right? Because we don't have that. But what he says is what is required. Now, is required something you may want to have, or is required a little stronger word than that? Required is an absolute. What is required is a sound mental framework for decision making. So we know what we need. And I think it's something we're going to look at how to do it. And the ability to keep emotions from eroding that framework. So what are the emotions that erode people's framework? Steve talked about them. One of them is patience. I mean, the people that are moving the sand, you know, just letting the house fill up with sand, and 25 years later they come back and there's a house sitting there. I mean, is that not a perfect example of absolutely profound patience? It's like you put your house in the sand, you come back 25 years later, and darn it, you still got a house. Some of us over the last few years would have been happy if our capital had been like that. That we could have left it in the hands of the people we left it with and come back at least an hour later and found out that it was still there. So the second great emotion is greed. We need to get it in a hurry. We need to get, and Bob's making a whole bunch of money over there and I got to go over there, and Joan's making a whole bunch of money over there and I got to go over there. Well, it's just the emotion of greed. So here's what we know. What is required is a sound mental framework for decision making. Another thing Warren Buffett said is, I am a better businessman because I am an investor. And I'm a better investor because I'm a businessman. So what we can deduce from that statement is there's a connection in how to see the world. So if we're going to be a great investor, we need to look at the world as if we were buying a business, don't we? We don't need to speculate. What we're going to look at is how to buy a business. Well, what does a businessman look at? If you're going to go buy the business across the street, what are you going to look at? What does the business own? Right? It's called its book value. It's assets minus liabilities. So if we can buy these, it comes down to a formula. It's a ratio. It's called the price to book ratio. If we can get a cheap price to buy book assets, then we're going to achieve one of our major goals, isn't it? We're going to be able to protect capital. The second thing that Warren Buffett said, or the third thing, I've used two already, right? So this is the third thing, is that a business is worth what it earns. Like, why else would you own a business? If you own a business, what do you actually get out of it? Well, what you got out of it is the money that it makes on a day-to-day basis. So again, if we could buy those earnings at a discount, would we not create wealth for ourselves? Is everybody following this so far? Okay, just like buying a business, we're going to look at the book value. We're going to look at how much money now. How many people got caught in the dot-com craze? So what was the book value of the businesses? Zero. Zero. There was no value. There was no assets in the business at all. What was the earnings of the business at all? What was the earnings of the business? Zero. Some of them didn't even have cash flow, and people were paying millions of dollars for the stock. So can you see the difference? Can you see how solid? If you just go buy the book value at a discount, buy the earnings at a discount, you're going to protect your capital. So obviously paying $12 for $1 of earnings is better than paying $15, isn't it? So that's what, a 30% discount? Something like that, right? So if you could buy earnings at a 30% discount, are you not entitled to that discount at some point? You're entitled to get that money back because your money's going to connect to the average. What do people watch every day? The stock market, right? If you're going to listen to the news, what are you hearing about? Are you listening to the stock market news? The price went up, the price went down, the Dow's up today, oil's up today, Dow's down tomorrow, TSS's up and down. Well, this is like watching the drifting sand. I mean, if you stood in the desert, Steve, and watched the drifting sand and tried to figure out what to do by the drifting sand, well, oil's up over here. Well, let's go over there. No, gold's up over here. Let's go, and it's better. We'll go over there. In the meantime, the dunes are all shifting around all over the place, and the media has got you going to here and there. Well, do you know why they have television shows? Do you know why? So that you watch the commercials. The reason that radio stations exist is so that you will listen to the commercials. Now, is there the slightest possibility that anybody would be listening to the radio if they started to report on the value of businesses? No. Because it doesn't change. Johnson & Johnson is going to make the same money today whether oil goes up or down or not. It's going to make the same money year in, year out, catastrophe, no catastrophe. So if you look on the right-hand side of the equation, what should we be paying attention to? Well, we should be paying attention to the bedrock, shouldn't we? Right? Our compass. Where are we going? What's solid in our world? Well, do you know what's solid? Corporate earnings. Corporate earnings. The Dow, the New York got some bad news, bad economic news this week, but the Dow just went shooting up. Why? Well, because all the businesses in America are reporting stronger earnings than the market thought they were going to. So even though, the macroeconomics or microeconomics, whatever, had got a bad report, the bottom line is the people who understand businesses know that you got to buy those earnings and that they're constant. So we got two terms so far, right? Book value, got to buy book value at a discount. We've got to buy earnings at a discount. Is that a good sound mental framework so far? We're starting to get a picture, right? The next thing we want to know is that our businesses have money in them. So that's a little value called free cash flow. If you were running your own business at the end of the year, you got to look and say, well, is there any money left over? Because if there's no money left over, then the business isn't going to run very successfully very long. So there's two measurements of that in our world. There's free cash flow and dividend yield. Dividends is how much free cash flow the management actually gave to us as the owners. So that's a pretty important number. Again, if we can buy those at a discount, we're going to protect our capital, grow at an above average real rate of return, and protect it from taxes. So we have AIC funds that we all own. How do they stack up? Well, Advantage has a 16.8 PE. So that's $16.80 paid for a dollar of earnings. The index that Advantage is compared to is 22 to 1. So is 16 a discount to 22? Global Advantage at 11.4. The index is at 16.2. American Focused at 11.2, the index is at 20. Canadian Focused at 13.4, the index is 22. So if I bought you some cheap earnings, do you own some cheap earnings? Do you need to worry about them? Do you need to care at all? Do you need to worry about the news? Do you need to watch, go, oh, sigh, my portfolio went down? Like, it just doesn't matter because you bought earnings. We got to have some free cash flow. So the businesses are kicking out good, healthy, free cash flows. And look at the return on equity, the growth rate of the business. So the businesses in Advantage are growing at 16% per year. Imagine owning a business that the equity is growing at 16% per year, or 18%, or 20%, or 22%. Isn't that phenomenal? Is that a good compass? We can go to sleep at night and go, you know what? My businesses are growing.